oh, sorry. I just want to do something called the woolidge principle. Now, woolidge is a court case that you guys need to know. And I just want to just do it with you, just so that you can physically understand. Now, what woolidge does is woolidge applies a limit onto transactions as to how much they can be taxed by. So I do have this in the notes that I'm going to hand out next week, but I want to just do it with you today, just before we do this next example, which, okay, because it's got a consideration of woolidge. It doesn't affect the answer at all, but it's where you need to consider woolidge for the first time. Now, if you're 4861 or 2, you can get this. Okay, and let me just explain. So let me just do an example which will explain the woolidge principle to you. Is that all right? So let's imagine you've got a 15-year-old kid. Okay, what he does is he lends, sorry, I always do that wrong, borrows 1 million from his mom for 6 months. And let's imagine he takes the money and earns 2 million trading on the JSE. Okay, so and he earns 2 million trading on the JSE. And a fair interest rate, let's make it nice and round number, fair interest is equal to 10% per annum. Is that all right? So guys, just on a strict reading of section 7.3, what would happen on a strict reading of section 7.3? She gives him, borrows 1 million from his mother. Sorry, let's make it interest free. Okay. So guys, because it's interest-free loan from your mother, what happens? There's a donation, section 7.3, minor child. So tell me, do you think it's fair for the mother to get taxed on 2 million rand? Let's imagine the mother doesn't even know what a share is. Let's imagine she knows nothing about investing on the JSE. This was all done by the son. So what's going to happen, guys? Do you think it's fair she should be taxed on the 2 million? Okay, so this is kind of like what happened in the woolidge case. Okay, so what happened was SARS went, the son would never have earned the 2 million rand if the mother hadn't given him the loan. Therefore, we're taxing the mother on the 2 million. The mother said, you can't tax me. I know nothing about the stock exchange. Why are you taxing me? So what happened was there was a court case, and the court basically applied a decision, which is a fair decision. So what the court did was, I said, listen, okay, what should the mother have gotten? She should have gotten 1 million rand times 10% times 6/12. At the end of the day, had this been a normal business transaction, she would have gotten 50,000 rands worth of interest. Are you guys comfortable with that? So what the court did was it says we're going to apply the woolidge principle. Section 7.3 does apply. Okay. Now, if the mother had done all the trading on the stock exchange in her son's name, then she would have been taxed on everything. Are you guys comfortable with that? So if the mother had been doing all the trading herself in her son's name, she would be taxed on everything. Are you guys comfortable with that? Okay. However, this is not the case in this circumstance. So the fairest thing is the mother gets taxed on 50 and the son will get taxed on. How much did he earn? 1 million or 2 million? Yeah. So the son will get taxed on 1,950,000, and the mom, because of that woolidge limit, will only get taxed on what she would have received on the loan had it been an arm's length transaction. So there's a limit as to how much you can be taxed on. Are you guys comfortable with this? Okay. Guys happy? Does this make sense? So often in a question, they're going to tell you what a fair interest rate is. What happens in a question where they tell you what a fair interest rate is? You're going to have to calculate a woolidge limit with it. Or sometimes what they do is they say, had this been an arm's length transaction, interest of 60,000 would have been paid. What would that mean? The donor can't be taxed on more than 60,000 rand. Are you guys comfortable with this? Okay. There are 2 more court cases. Can I just go through it? So basically, income on income. Can the donor be taxed on income on income? I just want to do it now. I'll do it again next week in the notes itself, but I just want to get the principle right. It goes back down to who's actually in control of the investment. If the mother is in control of everything, you can be taxed on income on income. Does everybody understand? But in a trust situation where the trustees are in charge of everything, income on income is taxed in the hands of the beneficiary, not the hands of the donor. But I'll show you in the examples. Is that all right? Does that make sense, guys? Depends on who's in control here. In this case, the son was in control, woulidge applies. If the son was not in control, then the mother would get taxed on everything. Is that all right? So let's look at the next example, please, which is this one, Johan Mormon Family Trust. Now, guys, I'm going to do this question twice with you. There's a 4861 version and there's a 4862 version. Okay? So this is the 4861 version. So let's read through it. I'm going to ask you guys to do it in class. It says the Moorman Family Trust was created by Johan Moorman, an attorney in private practice living in Polokwane and an RSA resident 2 years ago. He made an initial donation of 100 Rand to the trust. The beneficiaries of the trust are Johan and Angela Moorman's two daughters, Jody, their estranged 23-year-old daughter, permanent resident in Australia. So Jody, and the reason I wanted to do this example as well is the table looks slightly different here. The two previous examples we've done, there's been the beneficiaries on the left-hand side and the donors on the top. This time you've got the beneficiaries on the top and the donors on the left-hand side. And I just wanted to show you the two separate ways that you can set up. But we've got Jody, and what is she? A non-resident. Okay. It says, and Nikki, 12 years old. Nikki, minor. And guys, in the trust column, it'll either be a beneficiary that's got a vested right or a C next to it. Does everybody understand? To show a contingent right. But we need to carry on reading. Okay. It says the trustee clearly stipulates that all beneficiaries only have contingent rights to the trust assets and income. The independent trustees can thus exercise their discretion and award capital and income distributions to beneficiaries. So all of these are contingent. Is that all right? C, 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 C. Are you guys comfortable? So they're all contingent, right? It says the property in the trust consists of the following. A fixed deposit of 2 million in a local bank institution. Annelies Moorman, Johan's mother, bequeathed 7 million to the trust in her last will and testament when she died during 2016. Okay. The trustees, the whole amount was placed on fixed deposit, and during 2017, the trustees decided to withdraw 1.5 from these funds in order to invest it in foreign shares. During 2018, they withdrew a further 3.5 million to purchase a local share portfolio. So guys, there's no donor for the fixed deposit. Are you guys comfortable with that? They withdrew money to invest it in foreign shares, so there's no donor for the foreign shares. Does that make sense? Because she's dead. She left the money in her last will and testament. She must have died. And what else did she do? They purchased a local share portfolio, so for this one, there's no donor either. So for the first three items, there's no donor. It carries on. It says foreign shares with a cost price of 1.5 million. Dividends on these shares do not qualify for any of the exemptions listed in section 10b2. Okay, so for the foreign shares, guys, none of it is more than 10% owned in the company, so you don't get a full exemption of it. Are you guys comfortable with that? Then, guys, it says a local share portfolio at the cost of 350. It says on 1 March 2017, Johan's private practice sold the office block from which they operated to the trust as a going concern for a market value of 2.7. The purchase price was settled by an interest-free loan from Johan in his personal capacity to the trust. No capital has since been repaid on the loan. Had the trust borrowed the funds, it would have paid interest of this amount. Okay? Guys, comfortable? So why have they given them that percentage? This is a woulidge limit. So we're going to have to do a woolidge limit as part of our solution. Are you guys comfortable with that? So this is for woolidge, and it's over more than 1 year. And they've given you a fair rate, and they've given you the official rate. Now, what does woolidge use, the fair rate or the official rate? Fair rate, not the official rate. Okay, the following information relates to these people. So what I'd like you to do just to start off with is, I'd like you to think about how you're going to calculate a woolidge limit, number one. And then secondly, can I ask you to go through the table and work out who is going to be taxed on everything in the table. Is that all right? So I'd like you to go through and do that. Start off with the woolidge rate, please. Okay, guys, so let's start. 240,000, sorry. Let's start. The office block, 2.7 mil. Everybody comfortable with that? Times by 7.5% for the year gives me 202,500. That's your woolidge limit. Guys comfortable with that? Let me tell you what happens with the level 2 question. They do it over a number of years. So do you understand this can be a calculation over a few years? This question is only over 1 year. So what they've done in their in your TUT, if you're a 4861 student, is they basically have limited woolidge to just knowing how to do it over 1 year, not over multiple years. 4862s, you need to know how to do it over multiple years. Okay, so we've got a limit of 202,500. What's the total amount net rentals from the office block? 240. Do you understand that the donor can't be taxed on more than 202,500? So I want to ask you a question. What do you think you're going to do with the 37.5? And I'd like you to think about it for 15 seconds, just to yourself, what you think happens. Okay. So most of you would have thought about prorating it. Okay, let me explain why proration is not the right answer. You got to do it in order of transactions. So tell me something. Do Jody and Nikki get their 20,000 Rand each before year end or not? Do they get it before year end? They do. The trustees exercise their discretion and give it. So what is the order of people getting it? So Jody gets 20,000. Therefore, the 202,500, we're going to go 202,500 less 20. And then Nikki gets her 20 as well before year end. So we're left with a balance of 162,500. Does everybody see that? And then at year end, guys, the trust gets given the remaining 200,000 Rand. So where is that limit going to apply? Is it going to apply to Nikki or to Jody, or is it going to apply to the amount that's left in the trust? The amount that's left in the trust. Do you understand? So you've got to do it in order of transaction, this one. So on a date basis, the guys get it, and you're going to take the 202,500, and it's slowly going to get smaller. And eventually, that last person that gets something where you cross that 202,500 threshold, that's when you're going to apply that woolidge limit and where you're going to stop stuff. Is that all right? But you'll see it in the solution now. I'm going to get you to try this and see whether you do it properly. Is that okay? So we've done the woolidge limit now. Is that all right? So what I'd like you to do, guys, is I do want you to actually answer this question. So it says, do Jody, do Nikki, and do the trust. Is that okay? And I'd like you to try for all three of them. Just to understand, guys, if Jody can't be taxed because she's a non-resident, because there's a donation, I need you to write out something with a dash in Jody's solution to say, taxed in so-and-so's hands. Does everybody understand that? So that'll form part of the solution. So I'd like you guys to try to do Jody, Nikki, and the trust here, not the donor. But do you understand if you're doing Jody, Nikki, and the trust, everything that's there for the donor will be a dash inside either Jody or Nikki or the trust? Does everybody understand where I'm coming from? So if you guys can actually just try to do that, if you can do Jody, Nikki, and the trust, and then also will you try to do all of the exemptions and stuff like that? I'd like to see whether you get exemptions right. Remember, guys, foreign dividends, there's specific exemptions for foreign dividends, and also remember for local dividends, there exemptions. Are there any annuities here? No, therefore, for dividends, it's going to be fully exempt. There's no annuity sitting inside here. However, for interest, guys, which there isn't here, well, actually there is interest here. Okay? remember you've got the different sections. If you need me to actually do revision on the interest section, just do it. I'll see whether you need me to do revision on interest with you. Okay, because you need to know all of the test one work to do this properly as well. Okay, just give it a go. Guys, just as a suggestion, write down Jody, write down Nikki, and write down the trust. Go through the table once. Go through it number by number by number, and go fill it into the solution. Don't try to do them individually. You're not going to actually be complete in your solution. So give Jody half a page, give Nikki half a page, give the trust half a page, and do it that way, and do it number by number. Just do it consequentially. Go through the whole table number by number, and go put it into the right place in the solution. Is that all right? So let's go down, guys. So the first, in Jody's tax return, this 50,000 Rand, what would you do in Jody's tax return with the 50,000? You need to put a dash down. You have to put a dash down because they cannot mark something if you do not write it down. Does everybody understand that? So you've got to put a dash down, and you're going to say, capital taxed in a previous year. Are you guys comfortable with that? And you get 1 mark if you did it. Going down, 40,000 interest on a fixed deposit. Jody's a non-resident. Is that all right? So I'm going to assume that you've forgotten what you did in test 1 so that I can go through it. So guys, 40,000 Rand interest earned by a non-resident. First of all, we're going to ask, is there a donor? The answer is no, there is no donor. Therefore, normal rules will apply. If there was a donor, it would have been taxed in the hands of the donor. Does everybody understand? Because Jody is a non-resident. Then we're going to sit there and say, does she carry on business in South Africa? And the answer is no. We can't see anything in the question. Okay. Does she stay in South Africa for more than 193 days in South Africa? Okay. Yes or no? 183, sorry. Days in SA or not? No, she's not in SA for more than 183 days. Therefore, she qualifies for the 10(1)(h), the big exemption, the absolute exemption, the one that can exempt all of your interest. So because she's not carrying on business, because she is not in SA for more than 183 days, therefore, it is fully exempt, the full 40,000 Rand. How many of you put down the smaller one, the 23.8? Do you understand why the 23.8 doesn't apply? It's because she's a non-resident. Is that okay? If this was in the form of an annuity, guys, okay, it would be fully taxable though. Do you understand? But it's not an annuity. Next number down, 2125. How many of you put down 2125? Because you're not supposed to. What are you supposed to do with foreign dividends? Are you always supposed to put gross foreign dividends in? Do you remember from test 1? You're always going to show the gross dividend. So it says there, dividends received on foreign shares net of withholding tax. Does everybody see that? So you're going to say 2125 times 100 over 85. Okay? And you're going to get a gross number. Does everybody understand? But that number is irrelevant. Why is it irrelevant? Because she's a non-resident receiving foreign dividends, and what's going to happen? We are going to say it's not taxable. Now, I need to actually just see what you did. Did you guys, sorry, I just wanted, it's 23,676, okay? You can't put down 23,676 minus 23,676 in your solution because it's not exempt, guys. What is it? It's not taxable. So you had to put down just a dash. You shouldn't have put it in and then taken it out. You just needed to put a dash in. Does everybody understand? If you put the 23,676 in and then took it out, you will get 0 in the question. Does everybody understand? How many of you sit there and go interest dash? Did any of you do that? Okay, so you as well. Do you understand that you will get 0 out of 2 in an exam? Okay, so I need to just explain something. Okay, so with the foreign interest, with the interest that you received, the 40,000, you have to go 40 in, 40 out. Okay, so let me just explain. So let's go into the solution and let me just do this with you. Okay, guys, it's got to look like this. It has to, because that's how tax works. It says the 40 is gross income, and then The 40 is exempt income. So there's 2 line items. If you put the dash in, you get no marks. Okay? Look at what you do with foreign dividends. What did they say? Foreign dividends are not taxable in SA, not RSA source in terms of 92A. 1 mark. Do you guys see that? Do you see that there's a difference to the way that you set out those two things? So in an exam, if we're marking, we need to see the difference between those two things, the way that you set out stuff. Is that all right? If something's exempt, it's got to go in and then it's got to go out. Think of it as sex, guys. First, it's got to go in, then it's got to go out. If your girlfriend looked at you and said, what is it? It goes in, it goes out. Let's just say that we did it, but we're not going to do it at all. All you guys would get really pissed off, huh? And that's what's going to happen in an exam. You've got to go in and then out, and to get the satisfaction of getting the marks. Normally it's 2 in an exam, not 1, by the way. Because there's normally 1 mark per principle. 1 mark for saying it's gross income, 1 mark for saying it's exempt. Here, it's not taxable at all. You only do it in 1 line. So when something's not taxable, it's dash. If something's exempt, it goes in and then it goes out. Please just understand that. I've marked for UNISA before, and there's been like 4 in income but exempt stuff. People get 0 out of 8 because they go dash, 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 and get 0 out of 8. You've got to go in, out, in, out, in, out, in, out. Okay? You guys comfortable with it? Sorry, that's not the way it was meant to come across. But do you understand the principle? Okay, please. Okay. If you did that wrong in test 1, it would have cost marks for you. This is probably one of the foremost reasons why people fail tax, that they don't set out properly. Okay? Because in any exam, this is probably 8 to 10% of any single exam is this, and you can actually lose 8 to 10% if you don't set out properly. And we are that pedantic when we mark. We mark like that. Got to show the principle. In gross income, but out. 40 in, 40 out. This one not taxable, just a dash. Only a dash. Okay. Next one, guys. Local dividends. So, guys, the 60,000 local dividends, the non-resident, no donor, in gross income, 60. That, it's a dividend, it retains its identity, conjugate part principle. 60 is exempt. Are you guys comfortable with that? Okay. Oh, sorry. Yeah. Where's this? Okay, sorry, they switched the amounts. I'm sorry. Just sitting. So it should be 60 less. 60. But again, it's 2 line items. It's in gross income, but it is exempt. And then the last one, the rentals to Johan. Is there a donor? Yes. Is he a non-resident? Yes. So because he's a non-resident and it's a donor, section 7(8), and whose hands is it going to get taxed in? The donor's hands. But again, guys, what you needed to do to get the marks is you need to either say section 7(8) or you need to say non-resident with a 0 there in the solution. Again, this is like the foreign dividends. It's just simply not taxed in the person's hands. Let's go through the minor child now. Okay, so Nikki, 50 retained income, what are you going to do? Dash, taxed in the previous year. The 40,000 interest on a fixed deposit, guys. No donor, therefore, I've got a vested right to the 40, taxed in my hands, 40 goes in. I'm less than 65, so I'll get the exemption for people that are less than 65. Sorry. So UNISA are very poor. Okay. Oh, sorry. Supposed to change that. Okay. Next thing, guys, the 2125. What are you supposed to do? First, you got to gross up. 2125 times 100 over 85. Why 85? 15% withholding tax there. Are you guys comfortable with that? Sorry. Okay. So 23,676 less exemption 25 over 45. Do you guys struggle to remember the 25 over 45 or not? Can I explain why? Okay, the reason it's 25 over 45 is dividends tax is 20%. So maximum marginal rate for individuals is 45. That always goes on the bottom. Does everybody understand? And then what ends up happening, guys, is the amount less your dividends tax goes on the top. So total is 45, less 20 dividends tax means that you're left with 25. And I can proof it to you if you want me to. I can proof that you actually end up paying the same amount of tax with a local dividend as you do with a foreign dividend. You can actually proof it back if you do that. Is that all right, guys? On a trust situation, guys, trust would be in a similar situation to this because they get taxed at 45. Companies are only at 28, so that's why you've got 8 over 28 because it's 28 minus 20 on the top over 28. Are you guys comfortable with that? Okay. You guys comfortable with the exemption? And if they ask you to calculate tax payable, you do a 6-quart rebate here. Have you done any examples of 6-quart rebates yet? No 6-quart rebates yet. Okay, so something I will deal with. Okay. Guys, next one, the 20,000 net rentals received. What's going to happen with the 60,000 gross dividends received? So dividend, 60 in, 60 out. Guys comfortable? And then the 20,000, what's going to happen here? Taxed in the hands of the donor because father donated to minor child. So there, guys. By the way, that should be 60 less 60. I don't know what they're doing. Are you guys comfortable with that? Okay, we're going to do the last column now. Okay. The 80, guys, interest on fixed deposit, what happens? Does anybody have a vested right? Is there a donor? No, therefore, who's going to get taxed? In whose hands? Trust. Does a trust get an interest exemption? No. So if you look at the solution, trusts don't get an interest exemption. So only human beings that get an interest exemption. If it's a special trust for a disabled child, then yes, there would be a interest exemption, but not normal trust. Dividends received on foreign shares, what are you going to do with the 4250? First you need to gross it up. Sorry. Guys, to gross it up, 4250 times 100 over 85. And then it's a trust. So just use that same principle that I've got. Trust pay, dividends tax at 20%. So 45 at the bottom is the rate that trust pay tax on at a maximum rate. And on top will be the 45 minus the 20, which is a 25. So 26,307 exempt. Guys, comfortable with that? Next one, local dividends. Oh, sorry. Guys, the 51.5 gross dividends, what are you going to do? No one's got a vested right, therefore taxed in the hands of the trust, 51.5, but it retains its identity as a dividend, therefore fully exempt. So trusts do not get interest exemptions, but they do get dividend exemptions. Is that all right? 10.1K applies for everyone. Interest only applies for individuals. That's why there's no exemption for the interest. And then, guys, have a look what happens here. Can you see that 37,500, guys? Okay. When we went back here, we said the woulidge limit is 202,500. Total income was 240. So what we're going to do is we're going to say, listen, 240 total less 202,500 leaves you with 37.5. Everybody comfortable? So the donor cannot be taxed on that 37.5. So far, he's been taxed on 20. He's been taxed on that 20 as well. He can only be taxed on another 162,500. So your hand will be taxed on 162,500 out of the 200. And whatever's left over, that 37,500, gets taxed in the hands of the trust. Because it can't go to a beneficiary. They don't have a vested right. So do you understand where that 37,500 goes into the trust from the woulidge principle? Is that all right, guys? So inside the solution, woulidge principle, 37,500 rand in there in the hands of the trust. And if you did your Hun's tax return, he would get 162,500 for your Hun. And those two numbers added together total up to the 200,000 that you've got in your table. That went into the trust. If you're a level 2 student, guys, they can ask you to do woulidge over a number of years. So you have to do a cumulative calculation for woulidge in level 2, not just 1 year. Is that all right? So level 1, guys, both of you need to know woulidge. Just level 1, they tend to limit it to 1 year. Level 2, you tend to do it over 2 years. The level 1 students in the class, you comfortable if I do level 2 woulidge questions with you? Is that all right? Okay. So I'm just going to finish it off. So level 1 students, I've done just about everything that's in your test, barring one CGT section that you need to know. The thing with level 2 students is you need to know all of CGT. So I'm just going to tell you what's still left over. So what's still left over is the following. Just like with 7, 2, 3, 4, 5, 6, 7, 8, you've got the equivalent sections for CGT, except for the session of income section. You can't have a usufruct for CGT purposes. So section 7.2 for spouses is paragraph 69 in the CGT legislation. 7.3 and 7.4 is paragraph 70. 7.5 is paragraph 71. 7.6 is 72. 7.8 is 73. So you've got the same sections for CGT, but the level 1 guys don't need to do the CGT sections. Okay? However, what you do need to do is there's another section, which is section 8, well, paragraph 80 in the CGT legislation, which just discusses the concept of how assets flow through trust, which is still to be which I still need to teach for 4861 students. So what happens if you give it to the guy directly and then the trust sells it and does stuff with it, or if the trust gives it to you out of the trust and stuff like that. So those transactions I haven't done with you yet. So there's a little bit of CGT still left for the level 1s. And then I've still got to do all of the sections for the same section 7 sections I need to do with the level 2 class as well. The level 1 students, who are you? Do you want to sit in on those classes while I do the CGT? Is that all right? You don't mind? So there'll be about half an hour on Tuesday where I'll do stuff. And then the examples that I do will be 90% level 1 work and 10% level 2 work. Are you comfortable to sit in? Is that all right? Okay. So that's what's left for trust. Is that okay? Other than that, trust's basically finished. Guys, can I just make one more warning? Okay, please do not speak to your friends at UJ. Okay? What happens at UJ, and I don't know whether they're going to do it this year, but they seem to think that they need to teach trust at what would be QE2 level. And they've got, there's all sorts of funny things when you've got half interest loans and all sorts of shit like that. That is not part of your syllabus. So if you pull out one of those examples and you have a nervous breakdown, just understand it's not part of your syllabus for board. I'm only teaching you what's examinable for board. Is that all right? So please don't. I've had students in the past that look at 1 or 2 questions. There's, I don't know, UJ in the past have put these questions in that are literally would make guys that are master tax practitioners hair turn white. So just don't look at that type of stuff if you've got friends from UJ, okay? Just do the stuff that's in your assignment. Okay, thanks, guys.